Welcome back to Alpha Recap, your aftermarkets wrap from stockalpha.ai. Today, we're unpacking some big policy and infrastructure moves that actually reshuffled sectors after the close. As always, if you have questions, you can reach us at stockalpha.ai. So, what really stands out here is...
Great to be here. There was a lot to parse today. The three headlines that moved markets were pretty clear. A reported U.S. federal program putting $2 billion into commercial quantum firms, Canada's new 15% content spend rule for streaming platforms, and a Bank of America note singling out data center stocks as key power players.
Right. Let's start with the big federal splash, the $2 billion for quantum. Walk us through what actually happened and why it mattered after the close.
Sure. Reports said the U.S. planned about $2 billion to accelerate commercial quantum development, and that the government would take equity stakes in some recipients, reportedly including IBM. That kind of direct investment does a few things at once. It injects capital into longer horizon tech, it can open up government contracts, and it changes how you model ownership and future dilution for startups.
So, does that mean the government's suddenly a venture capitalist for quantum?
In a sense, yes. I mean, governments have always funded early science. What's different here is taking equity as part of the program. That brings governance questions. Analysts note that it can alter valuation models. A public stake can reduce upside for private investors, or, conversely, de-risk a business enough to attract more private capital.
And the market reaction was immediate for some names.
Right. There was intraday rotation toward companies tied to advanced compute and quantum ecosystems. More broadly, it fed an infrastructure narrative, long-duration public capital backing the high-risk end of the compute stack, while private capex kept moving the nearer-term parts.
Which neatly leads into the second infrastructure theme today: packaging and data centers. Amkor and AMD came up, yes?
Yes. Amkor announced a land purchase in Arizona and packaging work with AMD. That news spurred about a 4.5% intraday rise for Amkor, and they also flagged an upcoming cash dividend of about 8 cents with an ex-date in early June. Separately, Bank of America named 10 data center names as key power players and pointed out big dispersion inside the group. Some names had moved as much as about 34% recently.
Right. And the other thing is, how do those pieces connect?
They connect through demand for compute. Federal money for quantum lifts long-term demand expectations. Meanwhile, Amkor and AMD's moves tightened the near-term supply side of packaging, which is essential as chip makers ramp. And data centers are the consumption point for a lot of that compute. So when investors saw the Bank of America note, they rotated into infrastructure plays tied to AI and cloud demand.
So we saw a rotation inside tech after the close, not broad market strength.
Exactly. Markets closed with sector rotation rather than broad rallies. Analysts note that investors were reweighting advanced packaging suppliers, chip supply chain names, and select data center operators saw amplified flows, while other parts of tech lagged.
Okay, let's switch gears to media and regulation. Canada's new 15% rule. This one grabbed headlines for streamers.
Honestly, I was a bit surprised by this one. Canada mandated that streaming platforms spend 15% of their content budgets on Canadian content. That's a direct compliance and margin shock for global streamers. Analysts noted Netflix and Spotify in particular, because those platforms now face a recurring content allocation that could show up in margins.
Hold on, say that again? 15% of what, exactly?
15% of content spending. So if a streamer budgets $100 million for content in a market, $15 million of that would need to be on Canadian origin content under the rule. The impact on margins depends on how much revenue comes from Canada and how companies classify that spending.
And the worry is precedent? That other countries might copy this?
Yes, regulatory precedent risk matters. If several jurisdictions follow suit, streaming companies could face a new, recurring expense vector that dulls operating leverage. It might also tilt capital allocation away from product and tech investments, which can indirectly affect demand for data center services and ad tech partnerships.
So, what did markets do after that news?
We saw some immediate re-rating chatter in media names and a few downward moves where analysts started to model higher content costs. Company statements will be the next catalyst as firms quantify their Canadian revenue and how they'll meet the requirements.
Right. And what should listeners watch for next on that front?
Look for company commentary in earnings calls and any filings that disclose Canadian revenue mix or content plans. Also watch whether other markets propose similar rules. That's when the valuation impact would become more global.
Okay. Quick reactions segment. Short bullets. Say them with me. First, quantum funding changes ownership dynamics. Second, Canada's rule pressures margins. Third, infrastructure names got a re-rating nudge. Now let's hit healthcare and biotech briefly.
On biotech, there were mixed signals, but some bright spots. Sapiens Therapeutics reported positive phase 2 data for luciceptide in glioblastoma, presented at the oncology meeting. They projected median progression-free survival of about 28.4 months, and median overall survival wasn't reached yet. Small sample, early signal. Promising, but risk remains until larger trials confirm.
Got it. That's encouraging but premature. Anything else in healthcare?
Yes, grants and capacity items like a surgical simulation center opening in India and career grants that can lift long-term innovation, plus a legislative move on pharmacy access that some industry groups applauded. Analysts noted that policy and grant activity matter for adoption and reimbursement down the line.
Quick hits time. Some smaller briefs that still matter. City Traders Imperium flagged multi-account retail behavior. A report showed slow uptake for next-gen GMO crops, and there was a heavy volume microcap that barely moved. Any common thread there?
Yeah, policy and behavior are reshaping revenue realization across sectors. Regulatory narratives, whether content rules or GMO adoption, are a proximate cause of re-rating risk. And microcap activity often signals short-term momentum, but carries elevated execution risk.
Okay, couple of one-liners. Micro-reactions. Right.
Yeah, that tracks.
Let's talk trade and industrials for a second. Customs found tariff evasion on freight rail couplers. What did that mean for domestic makers?
That enforcement can protect US coupler makers and ease price pressure for domestic suppliers. Analysts noted that assessed duties or curtailed imports would sustain pricing power and could alter short-term earnings for those manufacturers.
And small-cap energy. Presentations at the Louisiana Energy Conference were flagged as well.
Yes, management color at conferences is a classic near-term catalyst for small energy names. Slides and Q&A can shift sentiment quickly for thinly traded companies.
Right. Now, stepping back, what are the broader patterns you'd highlight from today?
There were 4 cross-cutting themes. 1. Public capital and policy are actively reshaping sector returns. The Quantum Programme and Canada's rule are examples. 2. An infrastructure rotation is back. Data centers, advanced packaging and compute are in focus. 3. Regulatory uncertainty is a common re-rating trigger across media, biotech and agtech. 4. Event-driven microcatalysts like conference presentations and clinical readouts still move thinly traded names.
So, what would you tell a listener to watch tomorrow?
Watch for official confirmation or details on the $2 billion Quantum Programme, which firms, stake sizes, and terms. Listen for company responses from streaming platforms about how they'll implement the 15% Canadian spend. And look for earnings or commentary from data center participants and utilities like Xcel Energy for power cost signals tied to infrastructure profitability.
Quick reactions. Favorite line of the day?
Probably that public money is now sitting in the front rows of quantum demos. It's a tidy way to say policy isn't just background noise anymore. It's participants' capital.
Before we close, one short clarifier. Everything we discussed is analysis of market moves after the close, not a call to action. We're looking at trends and what might follow.
Absolutely. To be clear, analysts note patterns and data. This is for informational purposes only. It's not personalized investment advice, and we're not recommending anyone buy, sell, or hold anything.
Great. Time for our 3 tidy takeaways.
1. Government capital can change ownership and valuation dynamics. Keep an eye on the quantum program details. 2. Infrastructure narratives are driving a renewed focus on data centers and packaging. That rotation was visible in intraday moves. 3. Regulatory headlines are real re-rating risks. The Canadian Content Rule shows how policy can create recurring cost vectors.
Perfect. If you want to dig deeper into any of these items, remember you can ask us questions at stockalpha.ai. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. I'm excited for tomorrow's follow-ups. Catch you next time.